Hey everybody, it's Pete Carmasino here at Chaikin Analytics. This is the halftime show here on StockCharts TV. Each and every week, kind of go over a lot of things that are happening here in the market. And today we're going to do that again. We're going to look at some charts. We're going to look at some ratio charts. We're going to look at some of the defensive sectors, kind of three in a row. And an indicator that I was talking to Dave Keller about on our interview just a few weeks ago on the final bar, that seems to be kind of playing out, pretty evidently. It's had a strong move, so we'll take a look at that as well. But just looking in general, and the markets are, in obviously in a bullish mood and have been for, if not almost all of this entire year. Certainly in the last few weeks, we've seen, indexes just climb to new levels, and everything's looking good. I mean, look, the issue is that the Fed is going to meet this week. We're going to get inflation numbers as well. We've got a lot going on. The S&P is now kind of trading and living above 4,300 as we record. It's about 4,316 or so, and that's about 17 points up from Friday. Kind of went right to that 4,300 level and didn't close on it or above it. It just slightly below it. But the point was, we know round numbers are kind of what they are. They're sometimes resistance for no other reason than it's just an easy number to kind of tag. But the other side of the coin is that things have been working. I mean, we talked about this again, and I'll say it here on this show one more time, that I personally believe that obviously the tech markets rally. That's not what I believe. We can see it, right? It's not something that really needs to be said. But I do believe that the tech indexes and all of these particular tech-heavy names have moved rapidly because they anticipated the slowdown in inflation, which would mean that the rate hikes, the velocity of rate hikes would finally slow down. We're not going to see these 75, 50 basis point hikes one after another anymore. Maybe we're going to see a quarter this week. And I don't think that's enough to derail the momentum. What I do think is that it's certainly easier to absorb and potentially has less of an immediate impact, not only just on sentiment and behavior, but also even in the next several months going forward. So look, there's a bit of an earnings crunch. There's some sectors that have done extremely well, and there are some sectors that have not. Typically, the defensive has started to kind of roll over. Utilities had one of their worst first quarters in a long time, but at the same time, those defensives have already signaled months ago that people were rotating out of them, and we'll look at that chart again today. So again, as we always do, we don't want to put the weight of the evidence on our side. The evidence is out there for us to review. It's now interpreting it and putting it to work. So as we always do, we're going to look at a few ratio charts today. We'll look at some sectors. We're going to drill down into some other names, and we're going to look at the Chaikin list today that are kind of showing us a few names that are analyst darlings, are what we call them. We call them here on the Chaikin system. So let's take a look at the charts and see what we see. All right, folks, we're back here on the ACP platform here that we know and love. And I like this chart, so I'm going to start out with it typically all the time, only because it kind of keeps me in check. And I just want to update it on a weekly basis and have some, archive of what we've been seeing here over the last several months, really from March 13th, roughly that week, is where we saw the beginning of Rally 6 from the beginning of what we, most people were calling a bear market, although we've kind of just gotten out of that after hitting a 20% move off this October low, which was the beginning of Rally 4, right? The way I calculate it, I should say. And this is a weekly chart. We're sitting here right above what we said, right around 43.16, almost 43.17, with bullish percent really building momentum. And again, I'll look at this. There's three indexes here. The first one is, hold on, I messed up there. The first one is the New York Composite. Second one is the Nasdaq Composite. The third one is the S&P 500. And you can see it's been now quite some time since the bullish percent has really been in a downward trend. But the last 3 or 4 weeks, especially on the Nasdaq, we're looking at 6 weeks now, this being the beginning of the 6 week, of really strong momentum and bullish percent, and really breaking that downtrend that's really been in since maybe February of 2021, roughly, based on this chart. So when you see that, obviously there's going to be momentum there as well. The next chart I want to look at is a bit of a public service announcement as well. Invesco changed their equal weight symbols last week. So you're not going to know them as RHS or what the RHC, what they were before. They're now RSPD and RSPS, which is consumer discretionary and consumer staples. So the data is already updated here in StockCharts, which is great. And looking at what's happening here, you can see that crossover that started really at the beginning of this year, right? And this is tech heavy. Let's not be mistaken. The consumer discretionary index is very tech heavy. You got Meta in there, you got Amazon, you got a lot of names, you got Tesla. Lot going on in that specific ETF and sector. But when you're looking at it from a standpoint of wants, discretionary over needs, staples, you're seeing that continue to play out. And that's what's happening here on the market there. The other one I wanted to look at was the defensive sectors. And I think, bear with me one sec. Yeah, here they are. The three defensive ratios. Now, I have this really from, look at that, January 12th, right, is when you started to see this rotation out of defense and into, I guess, more of the growth names, right? You could use the word offense, I guess. But the point being is that this is, the top one is the healthcare, middle one is consumer staples, XLP, and this one's XLU utilities, right? So you're looking at these three areas, and all they're doing is really confirming the fact that the rotation is real, all right? And it's just continuing and getting worse, really, for the defensive sector, but not so much for, obviously, the growth area. And so when we look at that, we can quickly flip to something that we talked about also in the last couple of weeks, which is mega cap growth over mega cap value. Again, with a growth tilt now being in favor. And again, starting around, if you look at the crossover, it started really in March. But if you really look at the first area where it entered above one of the longer term moving averages, the 50-day moving average here, it was around that same week that we saw the defensive start to rotate down. Okay, so it's a domino effect. Money has to go somewhere. So it's a rotational effect in the markets. You can see where the dollar was at this particular point. It's still continuing to fall. You're seeing other countries raise interest rates, which will negatively impact our dollar, which is sort of good and bad. But, more importantly, it's impacting trade on a positive level, not so much a negative one, right? Our goods get less expensive. And you can see the S&P as well has just been really drifting sideways and finally starting to break out with a lot of momentum behind it. And so we do see the bullish momentum. We're not going to deny that, obviously. Okay, we want to look at the Nasdaq on a weekly basis. Again, look at that versus the S&P. They're at the SPY ETF. You can see that ratio down here has been really strong. And really in the first week of March is where it started to break out. But if you're looking at the Nasdaq 100 on a weekly basis here, it really held its longer-term 200 weekly moving average several times. Now, obviously, it breached it. You can't deny that. But at the same time, once you start to see higher lows and start to respect that moving average again, it was right around the same time the ratio took over where the Nasdaq started to beat the SPY. So the outperformance is there, and you can see that as well. The one indicator that I said I wanted to talk about today is just an interesting, and I'm not exactly sure why I started to even look at this, but I just started to play around with some ratios to see if there was any kind of identifiable trend. And I think I found one, but I'm not exactly sure if I can reliably say this is going to work every time. I wish I could, but I am showing you the fact that in the last 4 times this signal has triggered, it's been an interesting ride. And the last one here, which is the filled in arrow here, the big green arrow, was right around, you guessed it, beginning of March, where the ratio crossed over. They had the moving averages cross over on the ratio, but when the ratio crossed over the first moving average was the first week of January. So a lot of things kind of validating each other, right? It's trust but verify kind of a thing, and I think that's something that you want to pay attention to no matter what you're looking at, your indicators. You want to see multiple things triggering at the same time to kind of increase your confidence. Looking at TLT, we talked about this name or this particular fund for many, many years. As a matter of fact, I'm going to change this to a line chart. It's just easier to see. And you can see I talked about a Head and Shoulders back. I forget exactly when. It was probably late 2021. We talked about avoiding bonds and where this might go. And now looking at the next level, I mean, if rates were even to rise a little bit more, if bonds just got out of favor, or if they became less competition for stocks, that could roll over into this new area, and we'd have to break 100 and stay below there. It would be a pretty interesting move, but you'd still have to kind of respect it and understand that this isn't necessarily fantastic news. If bonds start to roll over, that means that rates are going to be rising higher than they are. So it's a give and take. But in that scenario, equities should be making up a lot of slack there and doing even better. And so let's see if that plays out, as we continue to watch these trends unfold. All right, we promised to look at some of the analyst darlings name here from Chaikin, from our secret list, as I like to call them. And some of the names here you're going to recognize, right? Some of these are going to be, you got a household durable name here, which has been unbelievable. But if I look at the definition of analyst darlings, I don't know if you can see this, but it reads strongest stocks in the Russell 3000 ETF, the IWV, with recent increase in bullish analyst activity. So that just means that the analyst activity, the way that we calculate it, and I'll show you what we mean, analyst rating trends, estimate trends are the two areas that we kind of measure when we look at these. And they're obviously on the very bullish side. Now, this is breaking out and looks pretty interesting here. We've got a new, almost looks like a new 52-week high. And it's really continuation of a trend that started way back when? January 13th. Looking at DHI, DH Horton, which is another household durable, but it's as a home builder. Now, this really started a long time ago. Really, this was really way ahead of the curve here in September 2022, back and forth over the long-term trend, but it really just has been powering forward. And analysts obviously are getting just more and more positive on the name right now. But you look at these are the other names here. Just take a look at them. You got Toll Brothers there, another one. I think this is another home builder. Yep, Tri Point Homes. Again, all of these names have been in longer term trends, and they've been looking great. A recent one that's interesting is Unum Group with this insurance company. Interesting, projected PE, not a bad yield. Market cap and revenue are kind of flipped there, so you might have some valuation at stake here, and it might be an interesting name to at least put on a watch list. And the last list I'll look at really quick, I'm just going to give you the names here. You can look at some of the charts yourself. But some of these names are what we call recent trend changers. And they're just names that have changed trend. And I'll show you the definition there. It's stocks that have been out of favor with intermediate term reversals likely to continue, right? The way we kind of calculate it. And so if you look, we're looking at relative strength changes, money flow very strong. Here's another one, NTAP, which is a very interesting name at these levels, up 2% today. Again, recent relative strength change. I think these are names you want to put on your watch list. Just take a snapshot here and take a look at some of the names that you see here on this list. I say it before and I'll say it again. Time flies when you're having fun. So got to wrap it up. Ran out of time again. Love to talk about this stuff. And thanks for tuning in every week here on the Halftime Show. I'm Pete Carmasino. Follow me on Twitter at Pete Carmasino. Take care. Bye.